I really titled this Thinking About International Investing because the main principle is to understand why you would or wouldn't and how much and how to do your international investing. So what's the main argument for investing internationally? Diversification. Because every country has its own risks, both political. We saw that there were some very sharp market movements on Wednesday after President Trump was elected. That's good an illustration of the single country and political risks of even the United States. So you mitigate those risks by diversifying those risks across a variety of countries. And by this logic, you should get more diversification as you go further away from your US-based stock portfolio. So foreign small cap stocks should have even less relationship to the US, and emerging markets should behave fundamentally somewhat differently from developed markets. One common point that's made is that US and foreign corporations make profits all over the world. Everybody buys Microsoft software and Toyota cars. But there's actually still a diversification effect even here. This is something Bill Bernstein mentioned at this year's Bogleheads meeting, because the profits are valued by the markets. If it happens that U.S. price-to-earnings ratio is higher than foreign price-to-earnings ratio, that means you pay more for Ford's European profits than for Toyota's European profits, even though both will make profits on their sales in Europe. But the stock markets are also dominated by domestic concerns. And this is also the reason for possibly getting better diversification from small corporations, because they tend to be more local. They're less dependent on the rest of the world, and therefore might give more diversification. And political risk can be diversified. I didn't, at the time I made these slides, I didn't know what was going on in the US election, but it was either going to be up in the air or Trump would win or Harris would win, and that's a political risk. And this is something that you really don't have a particular advantage in as a US investor, because if a country has some event like an election or a new law or disaster that affects the stock market returns, that's going to affect investors in all countries. So you don't get any particular protection against this by investing in the US. For emerging markets, you certainly have more political risk. I wrote the original version of this I did just after the war broke out in Ukraine, but that made Russian stocks essentially worthless. Usually that affects everybody investing in the countries, although there is the additional political risk that in emerging markets will have some policy that favors domestic over foreign investors. And I do understand that as a reason some people don't like investing in emerging markets. So why might you not want to invest internationally, or at least if you do invest, underweight it relative to the market weight? Well, there are some additional risks. Currency risk. If you buy Japanese stocks, then you get the return of the Japanese market in yen, which might not have any more risk than the return of the US market in dollars, but then you have the additional risk that the yen will change value relative to the dollar. And for emerging markets, you do have the additional political risks. And higher cost. The tax cost of international investing tends to be higher, even if you do it in tax deferred. You get, if a foreign country withholds dividends on its stocks, you can get that tax back as a foreign tax credit, but only if as a tax credit against your own tax. So if you hold the fund in a tax advantaged account like an IRA, you lose the foreign taxes. If you hold it in a taxable account, you get back the foreign taxes, but foreign funds have higher dividends and more non-qualified dividends, so the tax cost is still higher. And it's also, foreign funds are more expensive. Although that gap has usually gone down, it hasn't gone down as much if you're a value investor. That is, total market funds seem to be only a little bit more expensive in with foreign stock and bonds. but value funds are more expensive internationally because Vanguard doesn't have an index there. And it's also common your 401k options will limit things. It's fairly common to have a 401k that has a low-cost S&P 500 index and doesn't have a low-cost international fund. Sometimes you can mitigate that by holding your U.S. stock in the 401k and international stock in an IRA. And the elephant in the room, and one is past returns. It's certainly over about the last 12 years, foreign stocks have underperformed U.S. stocks. But I don't see any reason that should be an indication of future results. There's nothing inherently about foreign stocks that says that they should have lower returns. If they are less profitable, then they should be selling at lower prices, because invest in an efficient market, you should get a fair trade-off of risk versus return. So there certainly are plenty of periods that U.S. stocks have underperformed, and it would be better to be in foreign countries, and you see that in the reverse if you were a Japanese investor. The extra costs, on the other hand, are a real effect. You lose a little bit in returns by investing internationally, even if the returns are theoretically equal. So I'm going to switch back and forth to some charts from Portfolio Visualizer, which give a look at the data and which show how international stocks should work. They confirm that the returns are inferior, but the correlation is what I think is most useful, that adding international stock or bonds to a portfolio may reduce its risk. And as you might expect, if you get some risk reduction by adding large cap developed stocks, you get a little more by adding emerging markets, and you get still more risk reduction by adding international small cap. I'm a little bit limited by what Portfolio Visualizer offers at the free level, so that I can compare only a total international. I can't compare I don't have international large cap, although I can compare total international and then total international overweighting small cap a bit. So here's my first experiment, and I'm comparing 100% U.S. stock versus 70% U.S. and 30% developed versus 70% U.S. and 30% global, which includes emerging markets. And the most important line here is the standard deviation line, because the returns are going to be a lot more variable than the risks. So the standard deviation line here shows that the U.S. stock had a higher standard deviation, that it was more volatile than adding 30% developed markets. Adding emerging markets and using emerging markets with the same international weight actually increases the standard deviation slightly, although I think that's a case where the risk is compensation for extra return. It didn't happen in this time period, but I would expect emerging markets, because they're riskier, to have higher returns, to have higher expected returns. And even though this is a period of almost 40 years, it didn't happen here. But there is presumably some additional diversification benefit. So the next comparison, also all stock, is on the value of adding international small cap. Now, note that each of these tables I'm showing from Portfolio Visualizer, covers a different time period. I have as much data as possible. So the previous list went back to 86. This goes only to 95 because that's when we started to have data for international small cap. So I'm comparing 100% U.S. stock, then the 70% U.S., 30% global, and overweighting international small cap. And again, the key numbers is that the diversification benefit from international, and then in this case, an even large, we get a significant risk reduction just by overweighting international small cap, because that's, in fact, that's more than a risk reduction I'd expect. I would expect that there would be more of a theoretical benefit in return than a risk reduction, because international small cap does have all the risk of international stock. although it has less correlation to the U.S. portfolio. But then, because of the additional small cap risk, you should be compensated for it. Again, it happened this time that you were rewarded for taking the risk in international small cap. It isn't guaranteed. I'm using the total market, though, as my model for the comparisons I will do later. So, how about adding bonds? Well, foreign bonds reduce the risk of the bond portfolio, but it turns out that they really don't make much difference once you're considering that you don't care about how risky your bonds are. You care about how risky your bonds are in your whole portfolio, whether that's from bonds or stock. So first, let me look at the baseline of a portfolio. So now I have a 60% U.S. 40% stock, 40% U.S. bond portfolio. And then what happens if we add international stock to that? This is two portfolios, and the risk reduction, we get this again. The standard deviation has gone way down, as you might expect, because of adding 40% bonds to the portfolio. And again, because U.S. stocks happen to have outperformed. And I might as well here show a growth chart. So you can see that this is 2010, when from 87 to 2010, things are close, although there are periods of outperformance and underperformance. And since then, U.S. has gotten ahead. But you do get the risk reduction. Now let's see what happens. First, what happens when you add foreign bonds? Now, I don't have a way of underweighting. There isn't a foreign bonds in Portfolio Visualizer. There's a global bonds. So what I've done, which includes U.S., so I'm comparing holding global bonds at the market weight to holding about 30% of the bonds international rather than 40%, which is the market weight. Well, so here you can see the diversification benefit within the bond portfolio, 4.17% standard deviation if you hold only U.S. bonds, 3.63% if you hold foreign bonds at a little less than the market weight, and it actually goes up if you hold them at the full market weight. And these bonds are hedged, so you're getting $1 return on your bonds, but you're still getting the interest rate changes of the foreign bonds. This time, interestingly, the international investing wound up way ahead. The global bond market beat the U.S. bond market by more than 1%. And the non-U.S. bond market beat the U.S. bond market, therefore, by more than 2%. Again, I don't have any reason to expect that to continue. That's not a reason you should hold international bonds. But that is in the context of the bonds only. Now look at the whole portfolio. So now compare 60% stocks with the total U.S. bonds, and then add the global bonds the same way we did before. And then as a comparison, I'll show why, and I'll discuss this a little bit more, why you want to hedge your bonds here, because I have now a comparison with unhedged bonds in the third column. So now, well, the hedged foreign bonds didn't actually help. The standard deviation is higher with hedged foreign bonds. It's a little less reliable here because I have a shorter time sample. And the unhedged foreign bonds added a lot of risk. So my conclusion then is that yes, you should diversify your stock, and it doesn't matter that much whether you hold foreign bonds. And there are some reasons you might or might not want to. So I discussed the hedging. I mentioned the hedging briefly. The question is, should you hedge? And there's actually, I think, a good reason to say that you should not hedge stock and you should hedge bonds. And the reason is, what is the effect of the currency risk on the rest of your investment? Suppose the dollar rises against the yen. that means that it costs fewer yen for Japanese companies to sell in the U.S. That is, it helps Japanese companies make higher profits on their U.S. sales. So the currency return may be negatively correlated with the foreign market return. You gain money, you're more likely to lose money on the dollar to yen trade than you are when you gain money on the Japanese stock market. So most international stock funds don't hedge. Another reason not to hedge is that there might be tax costs for the hedges, which could matter if you hold these things outside of a tax-sheltered account. But for bonds, you don't have the same hedging benefit. The yen return of a Japanese bond doesn't depend on the dollar to yen exchange rate. It's a fixed yen rate. You might also think about the reason you hold bonds is to reduce the risk of your portfolio. And since you're spending dollars, you want to reduce the dollar risk of your portfolio, so hedge does this. So it does make sense to hedge bond funds. And as the last example showed, it's not just a theoretical thing. It seems to, in practice, have reduced risk by holding hedged international bonds. So now let's look at the costs. So I've chosen Vanguard's ETF for each of the asset classes that might be attractive to an investor, and then the least expensive foreign ETF. So we can see now that for the broad market investors, it's not that much more expensive. You pay 5 basis points for a total stock market, or 4 extra for a total bond market, or 3 for a small cap index. But Vanguard doesn't offer an international value ETF. So Vanguard offers an international value mutual fund, which is actively managed and is fairly expensive, or you can use ETFs elsewhere. For value, the least expensive non-factor value ETF is iShares EFV. In fact, if you want to hold large cap value, I would recommend using the factor-based fund, FIVA from Fidelity. For small value, there isn't a non-factor fund, at least not at a reasonable price, but Advantage is ABDV. And for the value factor, Vanguard's value factor fund. So the idea of a factor fund, a traditional value fund will hold the value half of the market. A value fund tries to specifically capture the exposure to value, have the stocks with the highest value characteristics. If you have that investment philosophy, Vanguard's value factor fund is all cap. And actually, it's about half large and half small. So what I said, the best comparison would be to hold an international large and international small value fund. And for these, you're paying a significant amount more if you want to do value investing. For the tax cost, foreign countries withhold a tax on the dividend. Usually in a taxable account, you'll get all of that foreign tax back. And I will go into a little bit on how that works. So in a taxable account, the tax cost of any stock fund is the dividend tax. And foreign stocks have higher dividends and more non-qualified dividends, so you'll pay more tax that way. In an IRA, it's the foreign tax withheld that you don't get back. If you hold a U.S. stock index in an IRA, you'll earn the stock market return minus the fund expenses. If you hold a foreign stock index, you earn the stock market return minus the expenses minus the withheld tax. So here's a standard example I used. Actually doesn't quite correspond to what things look like now, but it's reasonably close. So say you have a U.S. fund that has a 2% yield and all the dividends are qualified, and a foreign fund with a 3% yield and 2/3 of the dividends are qualified, with 8% of the dividend withheld as foreign tax. In the last few years, the dividend ratio has been closer to 2 to 1 than 3 to 2. So in an IRA, where you don't pay any tax, but you lose the foreign tax, you're losing 0.24%. That is 8% of 3%. If you have in a taxable account, assuming you get back all the foreign tax, both funds have 2% qualified dividends, but the foreign fund has an extra 1% non-qualified dividend, so you pay 1% of your tax on non-qualified dividends. If you're in a 24% tax bracket, then this example would be break even. But if you're in a high bracket, or if you're in a high tax state like California, and only a few states allow a foreign tax credit, California is not one of them, this suggests that it's a little better to hold U.S. stock in a taxable account if you have the choice. Again, you might not always have the choice. If your 401k doesn't have a good international stock fund, then you hold your U.S. stock there. On the other hand, I post every year, and I'm going to redo it once I get data for 2024, a comparison of the tax costs of factor funds. And I found value factor investors may well prefer the foreign funds in a taxable account, assuming you're going to hold them at all, if this is your investing style. Because the value factor funds in the US have higher yields than blend funds. DFAs are a little lower, but partly that's because they're more expensive. But I only have data from 2023. DFA's funds haven't been around long enough, but DFA's international value factor ETFs were extremely tax efficient. They had much more qualified dividends. The large cap fund was 100% qualified, the small cap 94%, lower dividend yield, and a very high foreign tax credit. So that gave them a very low tax cost. So if you are a value factor investor, then you may want to hold your foreign stocks in a taxable account. If you're a total market investor, it's probably better to hold U.S. stocks in a taxable account. And now I've just treated this foreign tax credit as something that you get. I'll continue now a little bit by discussing how you get it and whether you actually get it all, or how costly it is to get. The purpose of the credit is to avoid double taxation, and it actually works similarly if you pay tax to other states. I'm a Maryland resident, but I worked some in California last year, so I paid California income tax on the income I earned in California, and then I took a credit on my Maryland income tax to avoid double taxation. The tax works that the total tax should be at the higher of your two tax rates. So there are two ways to do it. One of them is to say, so your U.S. tax is 10% of your taxable income. Then the foreign tax credit is listed to 10%, is the lower of either the tax you actually paid to the foreign country or 10% of your foreign taxable income. Or another view, which turns out to be equivalent, if only 5% of your taxable income was foreign, then only 5% of your U.S. income was taxes paid on the foreign income. So the credit is limited to 5% of your U.S. tax. That's actually the way the form works. But these two views are mathematically equivalent. So how does it work in practice? Well, there's a simplified rule if your foreign tax is all from investments and it's less than $300 if you're single, $600 if you're married. That's around $125K single or $250K married of foreign stock. You enter all that. You enter that on a single line on your tax form and take credit for the full tax. Otherwise, there's a form of 1116 that you use to compute your U.S. and foreign taxable income. Usually, as an investor, you'll get your full tax as a credit. If you have something taxed at a much higher rate, for example, if you worked in a foreign country with a high tax rate, you might not get the full tax credit. If you can't take the full credit 1 year, you can carry it over back to the previous year or forward 10 years to use against extra credit in other years. Normally, the way you have to do it, the way the form is written, you do a separate calculation for each country. So if you're an American and you worked in both France and France and Spain both taxed your income, you'd look at how much tax you paid to France and how much of your U.S. income was earned in France, and then do the same thing for Spain. But the IRS allows you to just treat regulated investment company, which is something like ETF or mutual fund, as if it were a country, and do a single calculation, which makes the form a little simpler to fill out. The big issue on the form is how much of your taxable income is foreign. It's easy to see how much of your total income is foreign, but then all the adjustments and deductions that you use to get your taxable income, how many of those, which of those are allocated to your U.S. or foreign income? And the IRS rules don't always match reality. If you make a donation to charity and you deduct that, you can deduct that entirely from your U.S. income. One extra annoyance on the form and possible cause of losing tax credit is if you have either very high total income or very high international income. If you're in the 32% bracket, or if you have $20,000 in foreign qualified dividends and long-term gains, that would require about $1 million in foreign stock in a taxable account. Then you have to adjust the taxes for the fact that your income is being taxed at different rates. And the adjustment isn't quite fair. If you're in the 32% bracket, you should be multiplying by 15/32 to say that $32 in qualified dividends is taxed at the same rate as $15 in ordinary income. But the rule says you use the highest tax rate of 37 as the denominator. You do get to adjust your U.S. qualified dividends as well. But this can cause you not to get the full credit. And this is actually a good example of something tax software handles poorly. Harry Sitt, the finance buff, tried filing Form 1116 with 4 different forms of tax software. And 2 of 4 programs got the credit limit wrong and therefore claimed the wrong amount of credit. 1 got it right in his case, but in his case, the investor didn't need to adjust foreign qualified dividends, and it would not have worked right if they had to be adjusted. And the 4th one got the adjustments right, but didn't get the carryover right. So you're going to have to work with the tax software manually to get the form filled out correctly. If tax software usually has a forms mode, you may need to use a desktop version rather than an online version to do this, in which you can see the tax form and make your own entry on the tax form. This is what I've been doing for years because I do have international investments, and I've gone into forms mode with several different tax software programs. So to do this, you go out of the interview where it asks you things like, how much did you have in interest? And directly enter on the form some of the numbers. You have to check whether the form handled the deductions right. And in fact, there's one thing that your tax software cannot do. If you itemize deductions, you have to allocate your state income tax to U.S. and foreign income. And that's something the tax software can't do, because at the time you fill out your federal form 1116, you haven't filled out your state income tax form yet. So you don't know how to allocate your income. Because of all this, if you pay an accountant to do your taxes, it's probably better not to have international stock in a taxable account. Form 1116 is a complex form, and your accountant will charge you extra for doing it. If you do it on your own, as long as you understand what you're doing and go into forms mode, it's not that bad. I'd say I probably spend about a half hour of my tax filing now filling the 1116 out to claim my credit. And if you do get something wrong, well, the IRS may or may not catch it, but it probably won't matter. For most investors, the maximum allowed credit will be much higher than the actual credit you're paying. For me, it's usually double. So I have something like $1,000 in foreign tax, and my credit is limited to $2,000. So I'm happy to hold on to my international foreign stock. And the bottom line, what should you do? So I can look at what some of the best design models are. A lot of models suggest that 20 to 40% is the right foreign stock allocation. Currently, the 40% is a slight overweight to the market, but that's relatively recent. It used to be that the market was about half U.S. The ratios haven't changed much in recent years. So in particular, the all-in-one funds, which are based on some kind of modeling, are in that range. Vanguard and Fidelity are both 40% foreign. The TSP, which is the U.S. government's equivalent of a 401k, and Schwab are 35%. Those are the lowest cost all-in-one foreign funds. So all these have target date funds that will change their bond allocation over time but keep the same stock ratio. And as we saw before, international bonds really don't make that much difference in the context of a portfolio if you use a total bond fund. And therefore, you have this wide variation. Vanguard is 30% in international bonds, Fidelity 5%, Schwab uses none. In the case of the TSP, 0 is correct, because the TSP doesn't use a total bond fund. It has the G fund, which is a special fund that in the TSP only that's better than a retail bond index. And you would lose that advantage if you add an international bond fund. Similarly, for those of you who have TIAA available, TIAA traditional annuity is a better fixed income fund than a retail bond index. So you may want to hold all your bonds there, and you would not want to use international bonds. Otherwise, I say it doesn't matter, and usually when I give advice on the forum, I don't recommend it because it's an extra complexity. Okay. I'll take any questions.